Kitco News special coverage of the Mining Investment Event of the North is brought to you by West Red Lake Gold Mines.
Hey everyone, welcome back to Kitco News. I'm Jeremy Saffer. We're coming to you all week long from the Mining Investment Event here in beautiful Quebec City. Now, there's lots of news to get into today as gold and silver continue to break out. Mining stocks are finally starting to move as well. But for many names, this rally hasn't even started. Juniors are still trading at crisis-level valuations. And even as silver passes through $34 an ounce, retail and institutional flows into the sector still remain quite shallow. And at the same time, policy shifts are quietly reshaping the opportunity set beyond us here. President Donald Trump just signed an executive order reversing Biden-era drilling restrictions in Alaska's National Petroleum Reserve. Now, of course, this is opening new doors for U.S.-based critical minerals and energy development. Meanwhile, global miners are facing geopolitical risk as well as some national risk from Mali to the DRC. We're going to talk all about it. To break it down, we're joined by Michael Gentile. He's a strategic investor with deep experience in resource equities, board positions in multiple mining companies, and a sharp eye for value and symmetry in the market. Michael, great to see you.
Jeremy. Great
Welcome.
to be here. Thank you.
Okay, we got plenty of things to talk about here. I mean, obviously the room is quite set abuzz with these metal prices. We got silver back $34. Everyone's talking about it. But I want to talk to you because a lot of people are talking about the price of metals, but you're saying that this market is still missing kind of a deeper story here. What's going on with mining right now?
Well, you've seen gold making successive record highs month after month, but this, as you mentioned in your intro, the precious metal equities are still not really responding. Just recently, we're starting to see some broader interest in the sector. The junior resource sector in particular, like sub-$100 million market caps, it's still trading like gold is $1,500, $2,000 an ounce. Very hard to raise capital, very little interest, very little demand for junior resource stocks, which is highly unusual. Normally, I've been doing commodities for 25 years, Jeremy. When you see commodities making new all-time highs, the smallest companies are the ones rallying the most explosively because they have the most leverage to the gold price. There's a few reasons why. I think last time we had this kind of good vibes in the sector was COVID, 2020, 2021. The junior stocks did really well. Gold price went from $1,600 to $2,000 an ounce. All the junior resource stocks may went up 200%, 300%, 400% because people said, okay, margin expansion, it's going to be a big bull market. And then when you know what happened, which is the gold price went flat, and we had a hyperinflationary market environment where the cost went up exponentially. So that margin expansion that we dreamed of seeing in 2020 got all eroded away by inflation. The producer costs increased by $400 an ounce, and that profitability got eroded. Today, you've seen gold go up, $1,500 an ounce, or like $1,900 to $3,400 an ounce, where costs are much more under control. We're seeing record margins in terms of absolute and percentage basis by the big producers. They are spewing cash right now, buying back stock, paying dividends, pristine balance sheets. Q3, Q4, Q1, Q2 will be even better. 3 or 4 quarters in a row of record margins. We're starting to see generalist money come back to the bigger producers, and that'll eventually filter down to the smaller names, the developers and junior resources. So I think this rally is sustainable, and we're set up for a really explosive rally in the smaller cap, micro cap stocks in the sector.
Okay, okay, that's important to know. I mean, M&A, it seems like it's just taking off now, and of course, with gold being above it touched $3,500 on the spot side. Of course, we've been talking about the record-setting gold prices. What does this tell you about the sentiment? I mean, there's capital flow not really coming into the market yet. You mentioned those margins; they're printing cash. Yep. Is that what's going to bring investors back to the table?
If you look at the large companies, Jeremy, from after the peak in 2012, 2015 was really the depths of despair when the gold was $1,100. We had Barrick and Rio Tinto. So these companies were in serious financial difficulty. They've starved their exploration budgets basically since 2012 to today. So it's been about 13 to 14 years of very little exploration spending as an industry as a whole. So these businesses, they deplete their reserves every single year. So if you're not drilling for new resources and you're not buying them, you're on a treadmill where you got to replace resources and reserves. So I think we're going to start to see a very big M&A cycle as these bigger companies generating cash, great healthy positions, their stock prices are finally up a little bit. They got to put the next 10, 20 years inventory on the balance sheet of resources to ensure their sustainability. So we're seeing more M&A. I expect to see a lot more M&A. And also investors are starting to ask companies, how are you going to grow? The question for the last 10 years was, how are you going to stay alive? You have too much debt. How are you going to pay off your debt? The mindset's changing to can you grow? How can you sustain your business for the next 20 to 30 years? So I'm feeling it. I'm involved in a lot of juniors. The appetite of the corporates is much, much higher. It's no longer tire kicking. It's more serious discussions that were being had in boardrooms and around the corporate table. So I think we're going to see a big M&A cycle, and that should kick off again a better rally in the junior and small cap names, because as the market predicts more M&A, they'll start to reprice all the stocks in the sector to accommodate for that.
Yeah, this brings me to the next question, because of course you've talked a lot about asymmetry in the mid-cap developers and the juniors. Where are you seeing the biggest mispricings right now in that market?
Yeah, it's non-cash flowing assets. So the cash flowing assets, finally with these gold prices, people are seeing record margins. If you're producing gold right now, your stock is starting to rally. If you're a developer that needs capital, because the capital markets are not that yet. Institutional equity investors, retail investors are not yet supporting the smaller companies with their wallets. Because they're capital starved, they're trading at very, very depressed valuations. So if you're a producer that has the free cash flow to build these mines or invest in exploration, you can still get incredible value on non-producing assets and below would be where I see the best value.
So when you're going to the market right now and you're raising capital, I mean, how difficult is it for the juniors? Of course, we've talked about it on this show. It has been very difficult, but even with these high prices on the metal side, difficult to find capital?
Extremely difficult. Like I'm a director of 6 companies and I'm heavily involved in financings in the junior resource sector. The last probably 10 financings I've done, it's only been me dialing for dollars into my network of high net worth individuals. The brokerage community, while they're supportive, they don't have the deal flow yet. They don't have the financing. So the major gold funds are not inflowing money yet. There's not a lot of easy money around on bought deals at say a brokerage desk. It's starting to happen. Newfound Gold did a good deal this past week. But it's been very, very difficult. It's been incredibly difficult vis-a-vis the fundamentals being incredible. Usually it's this difficult when the sector's at a low level. But so to have this kind of positive fundamentals and still be difficult to raise money is quite an interesting juxtaposition.
So are the institutions starting to come back? I mean, with this M&A?
It feels like it. I did a lunch in Montreal the other day and I had, around the table 3 or 4 institutions that are not typically there. The generalist funds, which is a very positive sign. All the mining lunches I've been hosting the last 3 or 4 years have been the dyed-in-the-wool pure play specialist gold mining funds. Starting to get phone calls about generalists asking about the sector, hearing that they're starting to nibble at the edges on the bigger cap names like the Agnicos or the Alamos of the world. So I'm starting to sense it, and usually when they come in droves. And the other thing I'll recommend too is that the TSX is about 10% gold index. If you don't own gold stocks on the TSX right now, you're massively underperforming. So the Canadian fund managers are feeling that pain because if they're zero weight in gold starting to hurt your relative performance. That also attracts additional generalist funds who have to participate to catch up.
How much of it was just them waiting for a dip? I mean, the new reality is set. $33 or $3,300 seems to be a good base. I mean, the dip's not really coming, so they got to increase exposure somewhere.
That's a great point. So I've been obviously watching the trading of the stocks daily very closely. If you look in the rally, when gold went 3,500, then it pulled back about $300 an ounce. Normally, a $300 drawdown in gold, you would have seen the stocks get crushed, and they hardly pulled back at all. So the days where gold was down, the stocks were flat and they were getting bought. And the days that are up, like yesterday, huge rallies. Right? So you're seeing the dips being bought and you're seeing the up gold days have explosive returns. That's a very, very good sign. It means the relative strength of the group is much better and the resilience, people are waiting for those dips so they're not getting them. So now they're having to chase, which is a good thing as well.
I'm curious too how much of it is this macro, the headwinds that are happening. I mean, we got Donald Trump just signing this executive order, of course, with uranium and different mines, including strategic minerals. Of course, we got this new one. He's reversed Biden's drilling ban in Alaska. How big is this kind of momentum with things like that in these headlines for U.S. mining and energy investors?
It's really important. So, another reason why the junior resource stocks have not traded well is that the permitting timelines in North America, say tier 1 jurisdiction, a lot of investors say, I want to own a mine in Canada, I want to own a mine in the U.S., but the dirty secret or the bad secret of the industry is in Canada, the average time from a first discovery hole to production can be 29 years. So while these jurisdictions are great to own mines in, they've been very, very difficult and cumbersome to get permitted into production. So what Donald Trump is doing in the US, say what you want about Donald Trump, but very, very positive for the mining business. And in Canada, quite shockingly, during the last federal election, all the parties were getting behind mining and resource development, which has never seen that in my career. So that's very, very positive. We need to shorten the timelines, make it easier to get mines permitted in an environmentally responsible way. If you can shorten those timelines from 29 years to kind of 10 to 15 years, the value of these deposits go way, way up.
Okay.
So it's very, very important what you're seeing.
I have to bring this up because, of course, we are up here in Canada. We've been hearing this 51st state narrative, been going around for a while, and we saw Prime Minister Carney meet with provincial counterparts yesterday. I think they were talking about getting resources to market. Is this a good base case, talking about Trump kind of getting things together, Canada getting together? It seems like it's a good time to be an investor in the sector.
I have a controversial view. I said Donald Trump's the best thing ever happened to Canada. I'm a proud Canadian, but what I meant by that is Canada will stay Canada, will not become a 54th state. But what Donald Trump has done is given us a bit of a kick in the butt, and you're starting to see Canada get serious about developing the resources in our country. If you want to have true independence and have a bit of separation from the US in terms of economic independence, the best resource we have in Canada is our massive undeveloped resources, whether it be uranium, base metals, and gold. So that's why I think we're seeing interprovincial trade barriers fall. We're seeing Quebec talk positively about oil and gas pipelines coming through their province. We're talking about mining companies saying we're going to accelerate the timelines to development. This is very, very positive for our country. So whoever the government is, whoever is in charge, that 51st state talk, I think has given us the kick in the butt that we need to get serious. But we've got to follow through. Talk is cheap, but actually following through with systematic reformation and regulation changes in our country to allow the development to happen is essential. We could be one of the richest countries in the world in Canada.
Oh my gosh. If you had it to market, I mean, how significant, if you went from 26 years or 29 years permitting down to 4 years like they plan on doing in the States, or 2 years even. It's a game changer.
100%. And the amount of capital that would flow in, part of the reason why developers can't move their projects forward is their cost of capital is very, very high. If you come to me as an investor and say, hey, Mike, I made a discovery, when do you mean production? I'll be production in 2065. I go, well, your company's not worth that much. If you can tell me I'll be production by 2035 or 2036, then your cost of capital goes way down, the capital available to build these projects goes up, and the economic activity in your country goes way up, which is a positive for all Canadians. Forget about just mining guys like myself. But for the whole country, the job creation, the wealth creation, but we've got to create an environment that's attractive for capital, and capital is global. It'll go to Latin America, it'll go to West Africa, it'll go to Europe, it'll go wherever it's easiest to get a good return in a safe jurisdiction and a positive jurisdiction. So Canada has to up our game, US as well, and US is doing a good job, so Canada's got to pick up the pace.
Pick it up. Okay, well, you brought up jurisdictions. We got to talk about it. I mean, there's some interesting things happening. Obviously, Mali had seized Barrick's mine, and they're continued. I think today they put a little delay on that ruling. Ivanhoe's massive Kakula copper mine in the DRC is getting flooded. I think they're at about 50% capacity. How should investors think about jurisdictional risk right now?
Yeah, again, another controversial take there too, right? There's a perception by investors that US, Canada, Australia, good, Latin America, West Africa, bad. And the way I look at things is more risk, how much risk you're taking, what's the return you're going to earn for that investment. So in West Africa, from a discovery to a producing mine, probably 5 years or less. In Canada, that's 25 to 30 years, let's say, right? So the timelines, the cash flow paybacks are much, much quicker in West Africa, but you trade off less certainty on taxation and fiscal regime. So what you're seeing in Mali and other parts of I'm quite bullish on West Africa. I'm director of Roscan Gold Company in West Africa and Mali, so I know the situation very well. Yeah. What you're seeing is these countries rely heavily on mining. Gold price goes up to $3,500 an ounce. They want a larger percent of their revenues in the taxation share. So that's manageable in a rising gold price environment. But if you don't handle it well, let's say Barrick, you dig your heels in and say, no, we're paying this in 1990, we're going to pay the same thing we are today, that can cause a lot of friction. And so you have to really understand that you're trading off speed to market and timeline of regulation, environmental permitting, for less certainty on fiscal regime. But there's a balance between the two, and I quite like West Africa. Barrick's a unique case.
They want it retroactive, right? They want
Correct. Correct. They're saying, we signed the deal in 1990, terms are different today. We want a more fair share of the wallet. And I think there's a deal, most of the other producing companies in Mali have come to, B2 Gold and others, Allied Gold, have come to a deal with the government where they're kind of meeting in the middle or coming to an agreement. I think Barrick's been a hard line on them, and that's what's causing the problems there. But overall, West Africa is a very positive jurisdiction if you understand the risk and don't pay too much for what you're getting involved in. DRC, I think it's an unfortunate event. I mean, you saw the rebels, but security is an issue in West Africa and these other countries as well. But the DRC, a geoseismic event is something that can happen in Canada, can happen in the DRC. They'll get past it.
Is it priced into these evaluations for those at this point?
In general, West Africa and Mali in particular is priced. I think it's the pendulum swung so negatively that's only room to improve. Yeah. But that's really, when you get in the weeds on valuation, it's what am I paying for it, what risk am I taking? And typically when you have an event like that, it's already priced in, not a bad time to get involved.
Talk to me a little bit about balance sheets with the juniors right now and surviving. I mean, you talk about that cost of capital being very expensive. Is it just diluting share structures at this point? I mean, people taking advantage of it?
So I've been telling my juniors I'm involved in, if you really have a really depressed value, say you have a resource of 1 million ounces, right? And you're trading at $10 per ounce in the ground. Yeah. My advice to them, if it costs you $25 an ounce to find new resources, stop drilling. If you're trading at 10, it costs you 25 to find it, pull back on the drilling. Is there accretive M&A? Can you buy ounces at $4 an ounce when you're trading at 10 instead of drilling for them? So a lot of my companies have been very active in M&A, and you can consolidate companies when there's no capital available. So I've been directing my companies to think like owners, think like shareholders. When the market's doing well and capital's available, drill more aggressively. When it's not, pull back, preserve capital, don't dilute your shareholders too much. Think like an owner, not like a company that feels like they have to drill every single quarter, every single year to justify their existence.
Yeah, I mean, if the rates stay this high and financings are still kind of in this drought, what does that look like for the upside in the sector?
So you're going to start to see you're seeing it already, a lot more corporates. You're seeing Kitco been very, very active on buying 9.9% stakes. I try to focus on projects where they have a really good pathway to become a potential mine. It's very hard to build a mine, it's very hard to find these mines, but the corporates will do natural selection. They will do all that hard work, and the ones that they're backing are ones they feel have a good potential. So if the market's not there, you're going to see corporates getting involved, you're going to see more M&A. And like I said earlier, I'm very confident the retail money is going to come back, because these prices, the industry is so across all the sectors I follow, I cover everything outside of mining as well. There's no industry that's more profitable and has a better outlook, especially in a tariff uncertainty world, than the gold sector. So a lot of generalist money is going to start to flow, and it'll find its way to the juniors eventually.
Okay, well, I mean, developers obviously like Artemis, we got a Cisco, others are trading at fractions of their NAV. I mean, where is the upside potential? What is the most value case here for listeners at home looking for value on the mining side?
So the producers are still really cheap. Look at the record margin. So, it depends on your level of expertise and risk tolerance. So I think the producers, you can buy an ETF like a GDXJ or GDX and get passive exposure to rising profitability and really cheap valuations in the producer sector. If you're a little bit more expert only and you want to go into near producing assets that are coming onto production near term, that's where you get a significant re-rating when you go from non-producing to producing. And if you have even more stomach for risk like I do, in the junior resource space, trading at these valuations, that's where you can make 3, 4, 5, 10 times your money. But there's a lot more risk there, a lot more failure rates, so you got to have a diversified portfolio. But overall, in general, top to bottom, this industry is showing the best value I've ever seen in terms of where gold prices are today vis-a-vis the valuations in the market, and the apathy is still present. It's a very unique setup for investors.
Michael, have the juniors smartened up? I mean, have they gotten better with their GA costs? Have they started to promote a little bit less and kind of legitimize themselves with the cost of capital being so high? It seems like there's a consolidation.
It's a great point. My other message to my juniors has been, don't spend $1 million on marketing promotion when nobody cares. You got to promote when the sun's shining, right? So I tell them, cut back on your G&A, cut back on your promotion, look for smart accretive M&A. Yeah, I think there's also natural selection that happens in junior space. The ones that have not got the message, they've gone down to negative working capital or basically bankruptcy levels. So the ones that have gone smarter will do well, and the ones that are doing the right things are getting rewarded by investors. There's less of them, but they are getting that cost of capital. The corporates are backing them, and so it creates opportunities to do more. You can buy out your neighbors. You couldn't do that 5 years ago. Right. So there is a select group of juniors that I think are doing things the right way. And the ones that are not, they're going to get filtered out by the market.
What is your red flags when you look at that?
A lot of things. Management ownership is very, very important to me. So, in junior resource space, you might have 3 full-time employees and 7 board members. So I say, how much do the board members own and how involved with the board? Because that's a big resource for these junior sectors. What's their G&A spend? What's their return on invested capital? Do they understand $1 of investment in drilling and exploration? How much value is that going to create with the drill bit? Do they have economic geologists? A long list of things, grade, scale, jurisdiction, a lot of factors I look for. I meet hundreds of companies, so often the creme de la creme will kind of come to the top. But I try to meet everybody I can, because you never know where the next good story is going to come from.
So interesting watching people. I mean, people might be writing checks at this show. You never know with these prices. I got to ask you about royalty companies. I mean, obviously they've been doing very well too. You look at Wheaton, and you look at some of these companies also printing capital at this point. Are you favoring those cash flowing royalties, or are you still looking towards more of the junior space?
I'm looking for leverage to the gold price. In general, royalty companies, they're great businesses, but they're trading at 2.5 times NAV, some of the big guys, right? So a lot of investors are hiding in the royalty space because they go, no capital costs. I have guaranteed free cash flow, but a lot of these companies only have 3, 4, 5% free cash flow yields. If you look at single asset producers in 2026, 2027, some have 20 to 45% free cash flow yields. They're going to free cash flow their market cap in the next 3 years. So that's where I see the most torque and value. And also, as royalty companies, as the market gets more robust and companies generate more free cash flow, there's less opportunity for the royalty companies to do deals because the companies are healthier. Royalty companies feed off desperation. So 2015, 2013, 2014, those are years when the industry was really on its knees. Royalty companies can do really favorable deals, where if your company has a pristine balance sheet, generating lots of free cash flow, why would you sell a royalty on your asset if you can fund it yourself? So there's less deals and more royalty money chasing fewer deals. Right. So the returns are going to naturally be lower in the royalty. So I'm less enthusiastic about the royalty sector.
Okay. Picks and shovels, I mean, you look at it in this space, if it does hit, if institutions come back, I mean, there's going to be a nice little upside on the picks and shovels.
Correct. Drilling companies could be an interesting place to look. Service providers, E&C companies. If we see that reformation of the regulation, the E&C, the building companies, all the ancillary services that go around building mines and creating infrastructure could be a really interesting place. If Canada's serious about building more, those companies should benefit, not even outside the mining industry, but just engineering construction in general.
Yeah, I mean, you've heard the buzz here. $35 silver, $35 silver. What is the thesis here? I mean, you've spoken about the supply and demand crunch in silver, but at these levels, I mean, do you see it going to 50? What are your thoughts?
So silver, we've seen the big rally in gold. It's been mainly central bank buying, diversifying away from the US dollar, which I think is a mega trend, by the way. I think it's going to continue to go on. To me, silver is retail, general public participation. When this precious metals trade goes mainstream, outside the specialists like ourselves, into the mainstream narrative, that's when silver does really well. Because it's calling it poor man's gold for a reason, right? You can buy it for $35 an ounce. So right now the ratio between gold and silver is about 100 to 1. Historically it's been 80 to 1. But why is that ratio blowing out? All the buying is coming from central banks. When retail or generalist investors start getting in the space, that's when silver takes off. And silver, by the way, is a great proxy for junior resource stocks. Because those are retail investors, the same ones that buy junior resource stocks. So I think we're very, very close to this trade going mainstream. And when that happens, silver should outperform, and the precious metal stocks as a whole should benefit from that tailwind as well.
Yeah, it's always been, the kind of unloved stepsister or brother, if you will. I mean, even at these levels at $34, we haven't seen this type of price since 2012, yet the silver stocks still lagging behind, albeit today doing a little bit better. Any favorite producers or juniors in that space?
Yeah, I mean, I like silver stocks can be a little more expensive, so I'm a little more valuation, but I really like Capitan Mining.
Okay.
It's a really good silver play in Mexico. You've seen a lot of M&A in the silver space. It's hard to find a project that has kind of that tier one potential, not trading at a very high valuation. And some of the silver producers are all getting snapped up pretty quick. You saw Mag Silver got taken out. You saw, a lot of these names getting Gato Silver get taken out. So the universe of silver producers is shrinking as we speak, which means investors are going to have to go down market cap to find new investment ideas in the silver space, in the pure silver space.
So interesting watching this M&A activity take place too. What's the most single misinterpreted, aspect for this sector that you would say to retail or institutional investors right now?
Again, I think that they don't understand how profitable this industry has become, how sustainable the profitability will be, and how like my partner at Bastion Asset Management, he's not a gold guy. He says this industry produces widgets, but they're producing widgets at very, very high margins with very high ROIs. And if you look at this industry right now with the profitability it has, sustainable profitability going forward, this industry should trade much higher multiples. And the market hasn't got, both on a cash flow basis or on a PNAV basis. So I think as that profitability becomes more understood and believed to be sustainable, we're going to see a systematic valuation re-rating of this group. And that will be a very positive development when we start attracting outside capital from other industries that are not mining focused.
So bringing it back to the macro, what does that mean for the price of gold? It touched $3,500. Are we going to see $4,000 by the end of the year?
So I'm more bullish on the gold equities now than I am on the actual gold price. I think gold price is going to be sustainable, mega trend, central bank buying, diversification of US dollar. But I'm less flummoxed whether gold is $3,100 or $3,500 or $2,900 or $3,600. To me, at this level of gold price, this industry is fantastically profitable. If gold prices go sideways for the next 12 months, the gold equity is going to do fantastically well. So we don't really need the gold price to go much higher to have great investments. Over the long term, I see a systematic rotation out of US dollars into gold as a new reserve asset on the central bank balance sheet. That trend is very hard to stop. And central banks are not price sensitive. They don't care whether gold is $3,500 or $3,300. They're going to be allocating a large percentage of their reserves to gold outside of US dollars. That's why you're seeing these rallies these sell-offs be a little less steep than usual, because there's physical buying that comes in to support the rally as central banks execute their systematic rebalancing of their portfolios.
I wonder what it means for the next couple of quarters too. If you look at it, a lot of these miners are just putting this in their bank accounts now. Once the news starts to flow, is that when they jump in?
So you look at Q1, the average gold price is not scientific, but reporting all the quarters I saw, between $2,850 and $3,000 an ounce. That was in Q1. Today we're at $3,300, right? So that's another $300 per ounce margin that didn't exist in Q1. And Q1 were already record quarters for the industry. So the margins are going to keep increasing for another several quarters here as the gold price filters through these financial. It's a lagging indicator, right? Yeah. The gold price today is Q2's cash realization. Q3 coming up will be even better. So we're still seeing several more quarters of improving fundamentals on a relative basis in this industry.
Next 6 to 12 months, highest conviction trade, what are you relying on?
I think the junior resource sector is going to be the one that's really going to rally well, and I think small to mid-cap producers. So if you can find a company that has 1 or 2 or 3 producing mines, they're still trading at very, very low valuations. And if you're as bullish as I am on the gold sector, reaching down to the sub-$100 million market cap stocks, you can see some explosive returns. But again, do your homework, diversify your portfolio. But those are probably the 2 places where I see the most value.
Yeah, well said. Michael Gentile.
Thanks to you, Jeremy. Thanks for your time.
All right, I'm Jeremy Saffron for all of us here at Kitco News. Thank you for watching. We're going to be coming to you from Quebec City all week. It's a fantastic show. Stay tuned, and we'll see you next time.
Kitco News special coverage of the Mining Investment Event of the North is brought to you by West Red Lake Gold Mines.